Okay, for those that don't know, myself and my co-host today, Sophie, I am a portfolio landlord um, since the late 90s. And so I've been buying properties, sometimes buying and selling, sometimes buying for clients. I ended up sourcing properties. I'd set up a sort of sourcing company back in the early 2000s so we could build successful portfolios for others. Don't do that. Please don't ask me to do that now. Built up my own portfolio, sometimes in personal names, sometimes as joint ventures, sometimes with family members, sometimes in limited companies, sometimes within a pension environment. But it's never really been commercial, with probably the one exception. So my personal sort of experiences around buy-to-let, service accommodation, holiday let, that sort of thing. And also, we've been running the mortgage brokerage again since about 1996, so pretty much 30 years. And we morphed into focusing on working with landlords over that time when we realized that landlords really wanted somewhere to come to that for that sort of specialist help rather than a generalist brokers. So that's my background. I'll introduce you to Sophie Hurley. And Sophie, if you want to just quickly just run through your CV.
Absolutely. So, hi everyone. I'm Sophie. I'm the co-director here at the Mortgage Home. We've been running the Mortgage Home side by side for 9 years nearly now. So very similar to Richard, I've got a background in portfolio in property as well. I've got a portfolio of properties, all holiday lets that I manage in my spare time. And day to day, I support landlords and help them build their own portfolios. And I do think that that knowledge that we've got of having our own portfolios and properties absolutely come into play then when we're supporting people on their journey and what they're looking to do. It's not just about mortgage interest rates and what lenders can do. We have that bigger picture with it. So yeah, if I'm at work, I'm property related, and when I go home, it's all property related as well. So that's me.
We do. We live and breathe it, don't we?
We do.
So we can wear different hats is probably the thing. So we do get it as a landlord. It's great when there's the good times, but we're also we're in the thick of it when there's the sort of downturn and challenges that you guys have as well. So hopefully, there's something to call on, and we can at least empathize as well with you on that. We're going to get straight into the questions now, and by a country mile, the biggest question on everyone's lips is which I'm paraphrasing. It's been asked in various guises. So this is essentially a summary of the main question. So what is the impact of the Iran war on the mortgage market, on rates, product availability, lender policy right now? What's the short-term future prediction? Interesting one, that. And finally, more practically, what can I do as a landlord, developer, investor do to get the best rates right now? So let's backtrack. We don't have to backtrack far, do we? 28th of Feb is when Donald Trump and the Israeli government came together and decided to start this war. 28th of February. It's 3 weeks ago, would you believe? But of course, as soon as that happened, there's been volatility in the markets. Now, specifically, 2 weeks ago, Keir Starmer made an announcement. It was Monday lunchtime 2 weeks ago. And what it was what was the impact on the UK economy so far on from the Iranian war. And within minutes, we were getting emails from lenders pulling products, and it hasn't stopped since. And there'd been very little warning about that. And to give you an idea, I mean, roughly speaking, there's somewhere around 8,000 mortgage products out there at any one time to suit different needs. And right now, there's about 1,400 of them that have been pulled and not replaced. Now, should we be panicking? No, I don't think so, because 80% are still out there. That we can cover every basis. We can still cover all your needs. I don't think you guys as landlords would notice the difference. And we're still not finding any issues in terms of being able to source suitable mortgages for you. But yeah, 20% of products have probably been pulled and not replaced. Now, is criteria changing? Generally speaking, not. However, what is a byproduct of rates being pulled and then replaced on a very regular basis is the impact on stress tests. So if you're refinancing a buy-to-let property, if you're buying a buy-to-let property, then you'll know that it's the rental income that drives the borrowing. And there's a stress test calculation that uses a certain interest rate, and the rent has got to cover that interest rate by 1.25, 1.5 times, depending on the lender. And of course, if that interest rate's rising, then you're not going to get as much bang for your buck. You're not going to get as much borrowing on those products. So as brokers, we're having to, try and be clever, try and make sure that we get those best rates for you. Maybe we've got to suggest different ways because, for example, if you take a 5-year fix instead of a 2-year fixed, that formula, that calculation is more generous. So there are some little tools in the bag that we can utilize to hopefully still get you the borrowing that you need. But that is definitely having a challenge for us as brokers that clearly then gets passed on to you guys. So what's been the impact on mortgage rates? Well, over the last sort of 3 weeks, if I summarize it in terms of just looking at the 2-year fix and then the 5-year fix, which are really the most common two categories of products that you guys ask for and that we do research on. So 2-year fix have gone up by about 0.6% in the last 3 weeks. 5-year fix slightly smaller, 0.5%. So that's what we're seeing. It's not all happening at once, of course, because it's extremely dynamic, volatile situation. But that's really where we're at compared to, let's say, mid to late February. Interestingly, so let's look back over the last year. Normal product pricing rules have been in place. And what I mean by that is that a 2-year fixed tends to be cheaper than a 5-year fixed because it's easier for the guys who are producing the products to be able to forecast what's likely to happen over the next 2 years. There's a bit more certainty compared to trying to look a further 3 years out for the full 5 years. Gets a bit wobbly. So guess what? They price that in slightly higher risk. So under normal conditions, a 5-year fixed is more expensive than a 2-year. Guess what? It's turned on its head, hasn't it? Because we've got so much unpredictability right now. We're starting to see, and this is more of a prediction, but I reckon this week onwards, we're going to start seeing 5-year fixed deals cheaper than 2-year fixed deals for the very reason that people cannot figure out what's in Trump's head and how this Iran war is going to pan out. However, it is really fast moving. And if we only look back to yesterday, Trump was threatening to bomb oil and electric installations unless the Strait of Hormuz was opened back up. And Iran have responded in like saying, well, we might bomb all the desalination facilities in the Middle East, causing obviously pressure back on Trump and a different thing. So here's the thing. Trump has called this 5-day ceasefire yesterday, saying that talks are going amazingly well with Iran. Obviously, Iran are going, what talks? So, fake news, what's going on? We don't know. But here's the important thing is that, and I said this on a video about a week, 10 days ago, Trump is a lot of things, but he doesn't want his opinion polls ratings to go down. He doesn't want the American people to really suffer for too much for too long and cause a big issue. And I think he's still trying to pull the strings in terms of how the Iran war plays out, and hence causing this ceasefire this week, because the immediate response is that oil has dropped by 10%. I had a look this morning. It was $114 a barrel. It's $100 a barrel already. So the markets are responding positively to how Trump is reacting and responding to this war. Does it mean he's totally in charge? I mean, who knows how it's going to sort of play out. So, and therefore the markets will respond in kind. So as you can see, it's really difficult to make any sort of predictions when literally day by day the Iranian war appears to be flip-flopping around and the markets are responding. Sorry. Oh, someone jumping in. So in terms of making any predictions, certainly from where I'm sat, I mean it's almost impossible. 3 weeks ago, before the war started, the markets in the UK was saying there's likely to be two interest rate drops in 2026 from the Bank of England, and the markets were very benign at that point, or on a downward trend. And I would have expected, and I've been telling clients that mortgage rates are likely to also pass that saving on, and we could see mortgage rates drop by 0.5% in 2026. Fast forward 3 weeks, and we're now talking about 3 rate rises in 2026. So how fast moving is this pace? And like I say, it could change again before the week is out. So predictions, I'm going to leave that to Mystic Meg. So let's get to the practical point. What can you do right now to try and mitigate this a little bit and to try to make sure that you can get the best rates possible? Well, if you are looking to refinance anytime soon and you're already engaged with the broker, what you must do, and you might want to jot this down as a sort of note to yourself, is to get all those docs over to your broker. Make sure that the tax calculations are in, the statements are in, the pay slips are in. If you need anything signing, get that in first, not last, because what we're seeing is that we're sending out research to our clients and they're going, well, that's a great rate. Yes, I'd like to go ahead. And we go, okay, would you send your docs in? It takes 2, 3, 4 days. And guess what? The rates have gone. So it's a complete waste of time. You must reverse that now. If you haven't done already, get every bit of documentation, get your ducks lined up. Then we send the research out because you've got to be acting on it straight away. Our team have been working through, and I mean, hats off to the team. They're working sometimes 7, 8, 9 o'clock at night because the no rates are getting pulled that evening, and we're having to stay late to get applications submitted before the rates are here because it's taken that long to get documentation for clients. So please help us, help yourself, get those docs in immediately so that when we do get the research out to you, then once you make a decision, we can press the button the next day or later on that day. We get little more than 24 to 48 hours notice at best from lenders, and sometimes no notice at all. Sophie, is there anything you think I've missed, or you want to just add about clients getting the best rates, or anything about what I've just said?
I agree with everything you've said then, and just exactly that. You can't sit on it, but I think the one thing just to add to that is people are nervous to make a decision under high pressure, and I get that. You want to be able to have a thought process on it, go to bed, sleep on it, make a decision in the morning. And obviously, given the circumstances right now, we're telling you that's not possible. But if you say, yeah, go ahead, lock it in, that's exactly it. We're locking it in. If the rates then do rise overnight, you've secured that rate. It does not mean, though, you're stuck with that rate. You're not bound to it. You're not legally obligated to take it. You could change your mind a day later, 3 weeks later, as long as you've not completed, which it's going to go through that process anyway of the underwriting, the assessments, etc. You can walk away, but you have secured it at that lowest deal on that day. The other thing as well is flip side, and I know this is probably not going to happen, and like, there's all this uncertainty, and it's likely that we're going to see more rises before we see anything else. If Trump goes to bed and wakes up the next day and decides to call everything off and things do start, settling down a little and we see any sort of decreases and they say, okay, we didn't need to be as hasty with the increases that we put out in rates, we can switch to those lower deals, but you're protecting yourself by locking that deal in at that point if they then do continue to rise, which, given what's going on, is the likelihood of what's going to happen with rates. So don't be nervous to such a degree about saying yes, go ahead. It doesn't actually mean that it's set in stone, but you've protected yourself.
I think that's a great point, Sophie, that you made about existing mortgages coming towards the end of the deal, and it's a question from one of our guests today on that particular point, that depending on the lender, you can press the button as much as 6 months before the end of your deal. Now, it is getting more unusual to answer the question specifically from one of our delegates on here, that it's moving to the norm is more 90 days before your product ends, that you can then lock in a new deal, but sometimes it can be up as far as 6 months away. So as Sophie said, get it locked in now, because if rates continue to rise, you'd be delighted that you've locked them in today in March. However, if we do turn a corner, if the Iran war does come to an end and the rates start to drop back down, then generally speaking, you can ditch that rate because you still haven't started it. If you did it 3 to 6 months ahead of time, you've locked it in, you push it to one side and you wait and see. And we wait and see as brokers. So there's absolutely no downside to taking action now, assuming you can, whether it's depending on your lender, you have to speak to your broker. Is it 30 days? Is it 90 days or is it up to 6 months? Your broker will tell you. And so we put a date in the right way. It's the first day that you could potentially make that decision and act on it now, because you'd be glad you did if for some reason we go to hell in a handcart, as they say. Okay, we better move on. We spent a good chunk of time, but rightly so. I wanted to really cover off that thoroughly. We'll go through at a quicker pace on the rest of these questions. Someone asked, Harj Singh asks, Sophie, if you can answer this one. After 5 years, is a property assessed as if it was a brand new mortgage or not?
So is this, so presuming you mean on like as a refinance when you're coming to remortgage?
I think so, yeah.
Okay, so it depends essentially as to which way we go. So if you come to us and you've got a product that's ending, that's been on a 5-year fixed deal, it depends on the way we go in the respect of, if you're staying with your existing lender and you're not applying for borrowing with a brand new lender to you, then in that sense, you're an existing client. They're not going to do a full assessment and ask for your income details, your outgoings, etc. They will, if you have been making sure that your payments are up to date, you've not missed any mortgage payments, they will just have a look at what is available to you as an existing client, offering you new deals to stay with them. The only exception to that rule is if you are doing anything that is classed as a material change. So that might be that you are wanting to borrow extra, or you're wanting to change the term of the mortgage, or you're looking to maybe change from repayment to interest only, or vice versa. If you do a full remortgage at that point and go to a brand new lender, so you've come to us, your mortgage is with Halifax, we recommend you move to Barclays, you will get that that application will go in as a brand new application. You'll be assessed as a brand new customer. They'll want to know the house value. They'll likely want to do a valuation on there. They'll need your income details, your outgoings. They'll do credit checks and will ask for all of your information as a brand new client to them.
Thanks, Sophie.
No worries.
Joshua Curry, you got your hand up, my friend. If you want to unmute yourself.
Hello, can you hear me?
I can indeed, yeah.
Brilliant. As someone that's buying more property, you hear a lot about share purchases and
Right.
different options of buying shares. So I was just wondering if you could tell me a bit more about that option and how lenders look at that, and yeah, is it viable, I suppose?
Right. Okay. I mean, brilliant question. I mean, it's really of the moment share purchases. So I'll probably explain a little bit what share purchases are, and then go on to give you some ideas of why this should be. If you are an active landlord who are really actively growing your portfolio in 2026, you should be making notes about share purchases, because they're the most exciting innovation I've seen in the buy-to-let property market in 25 years. So what is a share purchase? So they've been around for many years, share purchases, generally speaking, but not in the property market. That's been a little unusual. And I guess because buying properties in a limited company didn't really kick off in any sort of sense until around 2015. I mean, there were obviously landlords doing that prior to that, but it started to get into the psyche and onto the radar of the mainstream buy-to-let landlord. Now, why don't, if you are looking to buy a property and the current owner has got that within a limited company right now, then why not just buy the property out of that limited company and put it into your own limited company? You've already got it, it's already set up, your own company. So why on earth wouldn't you just do that? So there's two reasons why you wouldn't do it. The first thing is that if you transfer a property from limited company A into your limited company B to your company, then there's all the transaction costs and the stamp duty in particular associated with that. You've got the normal stamp duty rules on the tiered table, plus the extra 5% stamp duty for the second home. So it turns out to be a big chunk of change you've got to pay in stamp duty alone. Now, here's the thing. If you're buying the shares of the company, then the property is not changing hands. And therefore, the stamp duty is considerably different. There is still a little bit of stamp duty, but it's 0.5%. It's minuscule relative to you moving that property into a brand new limited company. But there's an even bigger benefit. Because when you're buying a limited company and multiple properties within that company, usually there's not many buyers in that market to start with, because there could be. I'm going to give you an example. I've got a client buying 50 properties in a limited company. How many buyers are there out there that are in a position to buy 50 properties right now? Not many, right? So if you are one of a few buyers in that market, you're going to be in a position to negotiate. And this client has negotiated a 25% discount on the true market value of those properties. You can argue whether it's true or not. He said it's going to be based on the Red Book valuations, and everyone will sign up to that. So it's going to be an independent valuation, not a rose-tinted view of what the true value is. And that discount can be used as quasi-deposit. So let's say the value of the assets, these properties, is £8 million. And he's getting them for 6 million. That's his 25% discount. We've now got a lender that will allow that genuine discount as if that was deposit. So my client will get a £6 million finance advance for him to acquire the property and the shares in that company. And yet he's had to put no deposit down, and he's now 52 properties ahead of the game. So it's unusual, it's an exception, it's not a general rule, but this is the direction of travel. We've got more lenders now starting to be innovative and start to allow within certain parameters. Now, of course, is it as simple as that? No. Is the devil in the detail? Absolutely. So look, I'm just going to pause here, because if anybody wants to have a chat offline more detailed about share purchases, then just put your name and just put the two words share purchase in the chat, and I'll reach out to you after the call. And look, we'll go into more detail. How does it work? How can you benefit from it? Because it is such an exciting opportunity for our landlords. We really need to get that word out to take advantage of those opportunities where you can accelerate your journey so much quicker without having to save up that deposit before you go ahead and buy. So Josh, really appreciate that question. And yeah, I hope you come across some yourself this year, mate. I'd be glad to get involved with you. So moving on, we've got a question here about development finance. So I don't know if you want to take this one.
Yeah.
Someone's asking, Sergey, asking about how can you purchase a development finance project with a minimal deposit? Now that is loaded with a load of 100 more questions. So we're going to have to keep it really simple. And if Sergey wants to chat in more detail about a particular case study, then we can do that. But any just high level sort of comments about the amount of deposit you may have to put in for a development purchase?
So with development finance, they are typically still wanting you to put in, very similar to like you'd see on a buy-to-let, around 25% in terms of the deposit or cash into the deal. There is exceptions to that rule. So when we're talking about absolute minimum that you can put away, put into the deal and get away with, there are circumstances where some lenders, again, very similar to what we are talking about with the other property, if you're getting a genuine discount on this deal, on this property, that in today's market, on open market value, it is significantly higher than you're purchasing it for. There are some lenders that will use a portion of that discount toward the deposit. So in lieu of you putting that in. Now, that's not to say that you don't have to have a penny. You just go out there and find a property that you get really cheap compared to its value, and off you go. You've got yourself a free deal. They still want you to have some skin in the game, so you're still going to look around 10% on those deals that they're going to want you to put in. But obviously, that is significantly lower than finding 25% plus potential costs of the actual development itself to do the property up. So that's probably, again, very high level. If you have got a deal where you think this is a genuine discount, the open market value is 20-25% more than I'm paying for it, then there's lenders that would take that into consideration.
Thanks, Sophie. Thank you. Just looking on the chat, we've got what is a tax question? There's quite a few tax questions actually being asked today. And so I've got to start by saying that, of course, we're not practicing accountants. We, like a lot of landlords, will have a team of different experts around them. So we do use a property tax accountant for Sophie and my portfolio, and it's someone that we also recommend to all our clients. So I'm going to cover off the question as in terms of a personal view, but if anyone wants an introduction to our property tax accountant, again, just drop your name and tax accountant into the chat. Just put the 2 words tax accountant, and we'll introduce you to our property tax accountant, and then you guys can have a chat and see where it goes. But the question that was on the chat and was also asked by 1 or 2 people in the registration was, should I buy properties in personal name or in limited company name? And it is a difficult question to ask, and as I said, it is a tax question, so this is just my sort of personal view. Really, one of the considerations is actually not financial at all. It's about legacy, because when I talk to many landlords and asking them why are they getting into the game, why are you devoting all the time to building up this portfolio, yeah, it might be about generating more income yourself or and so forth, but quite often it's also about leaving a legacy for my kids or my grandkids. And it's a lot easier to pass on properties in a limited company compared to in personal name. So again, the accountants can expand on that about share transfers, bringing children in as minority shareholders or as alphabet shareholders. Again, I won't get into too much of the detail, but there's many ways of structuring limited companies to bring multiple generations into the ownership of a company on an incremental basis that doesn't impact too much in terms of lending. So ultimately, then it can move across to those kids as you go down the line. So from a legacy point of view, limited companies are a better vehicle for that. From a tax point of view, again, it depends. I mean, limited companies, when Section 24, back in 2016, when Section 24 the Tax Act was implemented, that's when limited companies really burst onto the scene, because they were aware of mitigating the reduced interest you could offset. If you're a high rate taxpayer, you were restricted to basic rate. So taxpayers could only claim 100% of the mortgage interest rate. Whereas in a limited company, all your mortgage interest can be offset as a deductible expense. So hence limited companies became the in thing. And now they are the go-to method of purchasing property in 2026. Then it accounts for about 6 out of 10 purchases in a limited company. But here's the real issue, I think, with limited company and tax, is that if you are growing your portfolio, in other words, any surplus you're making in your limited company from the rental income, it's been retained by the limited company. You don't need it for your personal spending and personal use. It's going to stay within that envelope. Then the limited company is a very tax efficient vehicle. You'll just pay corporation tax on the profits. And of course, if the money's staying in the limited company, it can be used as deposits on that next purchase. It never leaves that envelope. However, if you are needing the profits out of that company to live on, then you've got a double tax thing going on. You've got corporation tax on the profits, and then you've got your own personal tax. So personally, be mindful of whether you are needing an income stream from your limited company or not. I'm not saying there's a black and white answer, but that also might sway your thoughts as to which way you might go. So, of course, it's complicated. And if you want an intro to our tax accounts, as I said, then just please put your details in the chat below. Okay, moving on. Sophie, could you maybe pick this one up? So how can property be transferred between spouses? Now, I realise that raises a few questions. I don't know if my lever is on the call. If she is, if you want to put the hand up. If not, we'll assume, because it can go two ways. You could be adding a spouse or removing a spouse, and I don't want to spend too long on it. So can you just briefly cover off whether you're adding or removing some of the things to consider?
Okay. Yeah. So if you're adding.
Sorry, Sophie. Is my lever on?
Hi guys, I think this is my question.
Brilliant.
For transferring properties. So yes, in that case, it's a removing rather than adding on.
It's a removing. Appreciate it. Thank you. Thank you. So sorry, Sophie. Yeah.
Helps to understand it a bit further. So if you're removing a spouse from a property, it depends on, there's a different answer depending on it being for a residential or a buy-to-let. So if it's your residential home where you're on there together, husband and wife, or you've got it in joint names currently, you're removing one partner of that mortgage, but they're going to remain living in that property after they've been removed. Lenders usually would have an issue with that because they'd want to understand the reason behind doing that. So to them, if you own a house jointly, both live there, and you're not actually separating, as in your partnership is separated, you're just choosing to remove one party from the mortgage, they'd need to sort of get their heads around it. There's not a lot of sort of common sense with lending, which is quite painful. And so they're very quite skeptical, our lenders as well. So unless we have a really sort of reasonable explanation as to why somebody would give up their rights to that property but want to continue living in there, then they would want to understand that. Essentially, for any lender that can understand it, we give the explanation and they understand that, then what we would see is that they do something called a transfer of equity. So you would, on a residential basis, you would have to have the application assessed in the sole name of the person remaining on that mortgage. They would have to be able to afford that mortgage based on their income and their outgoings. And if that all is fine and it fits and you've got that mortgage offered on that sole name at that point, then from a legal point of view, the solicitors would do a transfer of equity, which is essentially the 50% of the equity that was in the second partner's name that is now being removed is transferred to the first. Again, always have a conversation with your solicitor prior to starting anything like this. There are times where there would be stamp duty implications of receiving that other portion of the equity within that property. So understand that and any implications of that before you went down the route of starting that process, because a broker should be making you aware that there's potential implications. They can't advise on it. Lenders certainly wouldn't. So if you're not sort of aware of it up front, it will only come out at the solicitor stage. Buy-to-let, again, very similar, that they wouldn't need the background as to why they were being removed because they're not as concerned. You're obviously not living in that property. So again, you do a transfer of equity. And in that scenario, it's very similar. It's a reassessment of the application, but your income doesn't really come into play. It's the rent the property is generating, and that determines how much can be borrowed, etc. It would move over, but again, speak to a solicitor to understand any implications from a tax point of view by removing somebody from there.
Great. Thanks, Sophie. That's great. Right, we're into the last 10 minutes now. We're coming around the home straight, as it were. So we're really going to sort of pick up the pace. So we're going to be giving shorter, sharper answers to get through these questions. So Sophie, someone's asked, Saida asked, can we get buy-to-let mortgages if you're over the age of 70? Yes. Okay. And we can get mortgages that outlive you. Come on, now there's a
You can.
challenge.
You could
We
get
can
a
get up to the
mortgage
age
over
of
the age of
110,
70.
can't we?
You
With
can,
some
yeah,
lenders.
you can. Yeah, so no, have as many birthdays as you like,
Okay,
is the answer to
fantastic.
that.
We've got Matt Sanderson, daughter, 18 years of old, years of age, first time buyer, first time landlord. So a first property. This is amazing. Really excited about this. It's not going to be a house to live. It's going to be an investment. Can you get one that 18 years old? Can you be given a mortgage at that age?
Yeah. So good question. We talk a lot about general rules. General rules with buy-to-lets is that you typically have to be 21. You typically have to own the house you're going to live in before you go into buying buy-to-lets. They like you to walk before you can run in some instances, but there's always exceptions to those rules. The other thing is that we can find ways around it by it may be, for example, first time buyer, first time landlord, typically with lenders have a minimum income requirement. So it might be on that first property that the daughter needs to go on with somebody else who ticks some of the boxes for the lender. But that first one is always going to be the most difficult to get. As soon as you've got that, they're no longer a first time buyer, they're no longer a first time landlord. Things just start opening up and getting easier. So, yes, you can do it. You'll just have a smaller pool of lenders until she does need to have a couple more birthdays. She needs. It
So
doesn't
close.
mean so
She can
much.
have a house for her 21st, maybe. Okay.
I've done it for 18-year-olds, but it's easier as they get older.
Right. This next question might seem a little niche, but I suspect it actually will resonate with more people than you might initially think, because we see a lot of landlords that have got surplus short-term money, and so they lend it out to other landlords, investors, developers for a better rate of interest than they maybe would have got themselves in a savings account. And then when they need it back for buying the next property, then that loan agreement is called back in and the loan is repaid back to its original source. We've seen that actually quite a lot. But the question from Kieran McGee today is, if he's lent out, and I'm making the numbers up, Kieran, 100,000 quid to an investor, and it's due back, let's say, in 2 months' time. You've got an official legal loan agreement to cover that off, but it ain't in your account. It's with a third party right now. But you want to buy a property today, and you need to show proof of funds, which would be the money you've lent out. Now, we don't actually get that specific question too often, but so far we made some early calls to lenders, and the answer was no, not until the money's come back. They were little loath to trust that the money that you'd paid out as a loan would actually come back in. So again, like all these things, there's exceptions to rules. And if you've got a particular issue, Kieran, on that, then call us offline and we'll see if we can find a lender who would be happy on that basis. But it appears that who knew it? Lenders are quite cautious. They want to see the money back in your pocket. Okay, we've got a question about this is from. Oh, in the chat. Is one in the chat? Do you want to ask that one?
So somebody's asking, they want to sell a recently remortgaged property. How long do I wait before selling, or is there no waiting period? In short, your answer is you can sell a property at any time. The second part to that answer is that you may not want to, depending on the implications of breaking out of that deal that you've just remortgaged into early. So what I mean by that is, if you've picked a product that's got early repayment charges, it may cost a lot of money to break out of the deal that you've just entered. So have a look at the terms and conditions on the mortgage offer. If you've just recently remortgaged, if you're tied into that product, there's usually a penalty of a percentage. It usually drops every year by an extra percent so it gets cheaper the longer you have it until that deal completely ends. You can sell without penalty. And I'll just sort of caveat this, if you're getting into a remortgage or you're buying a property that you know you are going to want to sell, remortgage in the near future, make that really clear and really sort of apparent at those beginning stages. There's products out there without penalties to leave early. So if, for example, you came to us and said, right, we need to remortgage, but I am going to be selling in 6 months, 3 months, etc., we can make sure that the products that we're recommending up front is in line with what your future plans for that property is, so that you're not then stung at the back end. Yes, we've remortgaged, great, but actually it's going to cost you £5,000, £6,000, £7,000 to get out of that deal. So if you're wanting some advice and whether or not it's how much it's going to cost, and you've got the paperwork, feel free to send that over to us. We'd be happy to have a look for you. But that's the answer to that one.
Thanks, Sophie. Another sort of tax related question. So again, my caveat underneath, be warned, I'm not an accountant. Don't trust me. But I do have a personal view. And the question is, how does tax get calculated after a property sale? So of course, we're talking about investment property because there's no tax on your principal place of residence, your home. Not yet anyway. Watch this space, Rachel Reeves. Keep your fingers off. But on an investment property, assuming it's owned in personal names, I'll talk about limited company in a second. So if it's owned in personal names, then it's likely that there might be some capital gains tax implications. So in really simple terms, if you bought something for 60,000 quid so many years ago, you sell it for 100,000 quid, you've made a 40,000 pound profit, then that would be subject to tax. There is some allowances. I think we're down at £3,000 per individual right now. So if you own it in joint names or you've got 4 people own it, then potentially you've got 4 lots of 3K. So that's 12 grand you could reduce the taxable CGT gain by. And then once you've got that figure, then you just pay at various tax rates depending on what tax type rate you as an individual. Something you can mitigate that 40k profit by even further, and I want to give a bit of an outrageous example. It's an extreme example. Let's say this investment property you bought, but then you built on an extension on the side, something significant, and you spent 40,000 quid on building this extension. That 40,000 pounds, your accountant will say you cannot use that to offset your rental. It is not revenue expenditure, to use accountants' terms. So it sits there. You've spent the 40,000 quid, but you can't offset it against your rent. But when you come to sell it, because it's classed as a capital item, you can then offset that 40,000 quid extension against your 40,000 quid profit, and hey ho, you pay no tax. So that's in simple terms. If your property is in a limited company and you sell it, there's no capital gains tax, but you will pay corporation tax instead. And again, whoever asked that question, I think who was that? Herman. If you want more detail, again, we'll introduce Herman to our property tax accountants. Put your name and just the words tax accountant in the chat, and we'll introduce you offline. We have time, I think, just for one more question. And this intrigues me. Jackie Tilliard, I don't know if Jackie is on here. If she is, if she wants to unmute, because it's a very generic question. Is it worth refinancing my buy-to-lets? Now, that asks a myriad of additional questions. And I should refer you back to my first comments about the Iran war. It's a difficult time right now, and it's hard to predict the direction of travel of interest rates. So if it's urgent and you need the money, talk to us today, Jackie, because guess what? Rates are at the cheapest they are today. That's a fact. So you might want to start that conversation now. If you can hang on, because there's so much volatility, it might be worth hanging on and seeing what Trump does over the next week or two. And if you're glass half full, then maybe, come the summer, we'll be all forgetting what this nonsense was all about. But you never go. We are pretty much there now. So if there's anything else in the chat just before we wrap it up.
Somebody has asked, what are the current rates? It's so difficult. Yeah.
I would refuse to answer that on the grounds that whatever they are today, it'll be different tomorrow. So get your ducks in, get your ducks lined up, then we'll tell you the rates. It's don't
even know what the rates are. It's at the minute, and I think this is the thing. I was sending an email yesterday, typing up some rates, and I got an email pop up at the same time saying we're pulling these rates. I thought, oh my gosh, the amount of times we're redoing stuff at the minute. And it will always depend on your circumstances, the property, what type of property it is. If it's a HMO or a standard buy-to-let or a holiday, it's such a wide question. But if you have got something you're imminently looking at, so whether that is a remortgage, a purchase, just get in touch. We would be more than happy to have a conversation, look at your options, and give you a lot more specifics. relating to
Yeah,
that.
I mean, one thing I will say is about a month ago, we could get buy-to-let rates and resi rates starting with a 3 with sensible fees, might I add. Those days are gone. There's nothing starting with a 3 realistically. Unless you're prepared on the buy-to-let front. There might well be, but you might be paying a 5 or a 7% arrangement fee for a 2-year 3-point summit deal. Yeah, Bash, I see you took an intake of breath there. So you've got to really want that deal. And do you know what? That might be the right deal for some people, because if particularly if the 5-year rates are starting with a 3, and if I go back to the stress rate calculations, if that means you get the borrowing that you need and you're prepared to pay a 7% lender product fee, i.e. you're giving away some of your equity, it's only going to go to the kids or the grandkids anyway, isn't it? So let's be fair. So why not give it to the lender so that you can get that amazing low rate, you can release all the borrowing you need. So yeah, there might be some starting with 3, but they've got crazy fees. Generally speaking, they start with a 4 now upwards. But you know, look, what we're trying to do is get some content out on a very regular basis right now to keep our clients and investors appraised of exactly what the hell's going on as best we can. So if you haven't done, do subscribe to our YouTube channel. Listen, we only put content out when it's relevant. So you will get a tap on the shoulder then if you have subscribed. And whenever we put a little bit of piece out about what's going on in the Iran war, for example, or if on Karma Times, on more, you know, day-to-day changes that's going out in the markets, then you'll be made aware of that. So Kate, I think if you can just put, if you haven't done already, probably has because she's that efficient, put something in the link, click on it after there, click subscribe, and then at least you get that that update. And as I said, the recording of this will be in there within hopefully a couple of days. My good friend Tommy, who I know Gareth knows well, will be editing that and getting it up there. So do let your colleagues know about it, and then yeah, we can all get some benefit out of it. Other than that, keep an eye out on when the next Q&A is. We usually do it every 2 months. So if you're on, you should be subscribed to our database, which means that you'll just get a little update saying when the next one's due. Other than that, thank you so much for everyone that took the hour and stayed with us for the 50 minutes. Give yourselves a big round of applause. That's amazing. Thank you so much for doing that. Have an amazing day, and we'll see you on the next Q&A. Thank you.